Hey guys, it's Nick. Today, the Fed raised the Fed funds rate by half a percentage point, which is the biggest increase since the dot-com bubble burst in May 2000. And they also announced that they will start their tapering or reducing their balance sheet in June. And we're going to look at how much they claim that they're going to do it. And we're going to look at what happened the last time they claimed that they were going to taper their balance sheet. How long did that last for? So if you don't know, the Fed is in a tough position because they need to raise interest rates by a lot because of inflation, but they don't want to do that because that's going to crash the economy. And you also have an election coming up. So what they don't want to do is raise interest rates too much, but they want to have people in the market think that they're going to raise interest rates if they need to. Raising interest rates is also bad for the housing market, and we see that mortgage rates on a 30-year mortgage are already up to about 5.5%. So more increases in interest rates is bad for the housing market, as well as for the federal government debt, which is $30 trillion. So each 1% increase in the interest rate is $300 billion more that they have to pay in interest. And the government only takes in about $4 trillion from taxes. So each 1% higher that they have to pay on that interest is another about 7.5% of what they take in yearly. So let's take a look at the news and some of the numbers from today. So the half a point rate increase was as expected, and the Fed said that they will taper starting June 1st. Let's see by how much. So the Fed officially launched quantitative tightening, and they will start with cap reductions to the tune of $30 billion for treasuries and $17.5 billion for mortgage-backed securities on June 1st. And they say they will grow that to $60 billion for treasuries and $35 billion for mortgage-backed securities after 3 months. And Bloomberg says, we thought they'd start runoff at $20 billion for treasuries and $10 billion for mortgages. So the 30 and 17 was a bit more than we anticipated, but we don't see any major market reaction from this difference. So as a reminder to not listen to what the Fed says, but watch what they do, let's take a look at the last time they tried to taper. The bear trap's Larry McDonald summed it up best. The Fed went to $50 billion a month in September of 2018 and had to stop 5 minutes later in December. This was after promising Wall Street economists they were on autopilot all the way up to a $2 trillion reduction. Now they're going to try at $90 billion a month in May with back-to-back 50 basis points hikes. Who are they kidding? It's the worst start to a year for stocks in decades. Consumer savings is down to the bone. GDP prints negative, and the Fed is going to kick off a record tightening cycle. It is all a show. And as for an indication of where interest rates need to be based on what our inflation rate is, the last time we were at an 8% inflation rate was sometime around 1982. And the 10-year Treasury yield and the 30-year mortgage rate were up around these levels of 12 to 14% or more. So this may be a good start with 30-year mortgage rates now around 5.5%, but it seems we have a lot more ways to go. But the Fed is kind of trapped because although they talk a good game, they really don't want to raise interest rates too much. And so here, this chart shows the Fed rate versus the Taylor rule estimate, saying that interest rates should be around 12% at this level where we're at. And what's the Taylor rule? It's a formula that can be used to predict or guide how central banks should alter interest rates due to changes in the economy. And the rule recommends that the Fed should raise interest rates when inflation or GDP growth rates are higher than desired. And so we definitely have inflation much higher than desired. And so the Fed is way behind the curve over here. And so is the Fed going to raise interest rates 4, 5, 6 more times this year to get up to the 2.5% interest rate that they claim that they're targeting? I doubt it. So my guess is the Fed is probably going to look for some excuses to slow down or even not increase interest rates the rest of this year. Some of the excuses they could use are the war in Ukraine, the negative GDP print that we had in the first quarter, so signs of a looming recession, maybe the popping of the housing bubble with higher mortgage rates, which makes it more unaffordable for new buyers, or the stock market falling even more from here, or a combination of all of these. So with that said, it may actually be time to buy some of these beaten down bonds that have been getting killed because of the expectation of much higher interest rates. Let's take a look at a few of them. So the TLT, which is the iShares 20+ year Treasury bond ETF, is down from about 155 at the beginning of the year to about 117 today. And it's currently yielding about 2%. And so it looks to me to be way oversold if you look at these monthly charts. Anytime the monthly stochastic has gotten below 15, like here, 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 and here, it's had a pretty good rally from there, here as well. So it might be a time to get in for some kind of bounce. I'm not saying it's going all the way back to 180 or even 155, but from here, it could probably go to 130 or so, just on a kind of relief bounce if people start to realize that maybe the economy is getting weaker, and so the Fed is going to cut back on their rate increases. The same could be said for LQD, which is the iShares investment grade corporate bond ETF, currently yields 2.67%, very oversold on a monthly chart. And also HYG, which is the high yield corporate bond ETF, otherwise known as junk bonds. And it's yielding about 4.5% right now. And so to me, it looks very oversold, and it could easily go from 78 maybe to 82, 83 or something along those lines in the next few months. As for the stock market, I don't think we've seen the bottom. Of course, there could be rallies here and there going forward. I'll probably be looking to buy some low PE, good dividend paying stocks, or buying some kind of ETF like VIG or VTV or VYM, something along those lines. So as always, these are not recommendations. That's just me thinking out loud. Do your own research. My opinion on bonds and stocks could change in 5 minutes, 5 days, 5 weeks, 5 years, or any time in between there. Hope you liked this video, and I'll see you in the next one. Thanks for watching, guys.